In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance.
Hello, everyone, and welcome to the Week Ahead on Nomura podcast. My name is Ruben Paracuelas, Chief Southeast Asia Economist at Nomura, and today is Friday, the 19th of September. So we've had the Fed decision to cut by 25 basis points, as you heard from that clip with Fed Chair Powell, who was citing that downside risks to the labor market in the U.S. have risen. The dot plots were dovish, with the median 2025 dots pointing to 2 additional cuts, and for 1 more in 2026 and in 2027. In this episode, we discuss with David Seif, our chief economist for DMs, why we now expect substantially more rate cuts by the Fed and how he sees the impact of the appointment of a new Fed chair in coming months. Elsewhere, Josie Anderson from our London economics team previews the on-hold decisions we expect from both the SNB in Switzerland and the Riksbank in Sweden next week. In Asia, the data calendar is relatively light, but I provide some quick thoughts on Indonesia, which has been in the spotlight recently. Lastly, I sat down with Yusuke Miyari, our G10 FX strategist, who explains why he sees dollar-yen lower in the near term amid the latest political developments in Japan. Let's dive in. Okay, now let's kick off with the U.S. And yeah, I'm very delighted that David could join us today. Hey, David, thanks for joining us. Really appreciate your time as always.
Great to be back. Always a pleasure.
Yeah, so I guess it's all about the Fed this week. And after the FOMC decision to cut by 25 basis points, you and your team made some big changes to your Fed forecast. Can you walk us through the change and the rationale?
Yes, absolutely. So we added 3 more cuts to our Fed profile for cuts. We had previously thought that following the September meeting, the Fed would cut in December and in March and be done. And we added in a cut at the next meeting in October 2025. And then further into the future, 2 more cuts in June 2026 and September 2026. And that brings us all the way down to a terminal rate of 2.875%, 75 bips lower than we had before. And I really think it's worth separating both the 2 aspects of this. First of all, the October cut. So this really was based largely on the dots. We were surprised that the dots had come down the way they did. We had expected the dots to show just a single additional cut this year. They showed 2 additional cuts this year. And you sort of have to go with what the Fed says and listen to the Fed. Admittedly, it was a 10-9 split, so it was pretty close in terms of the median. But I think the balance of risk certainly is that they will go ahead and deliver those 2 additional cuts this year. I would point out, as we did in our write-up, that it was a little bit incongruous that the Fed changed its economic projections almost completely in a way that would have been seen as hawkish, and yet the dots moved dovishly. So it revised up its GDP forecast, up its inflation forecast, and down its unemployment forecast. And yet, at the same time, added in another cut in 2025. And although it's hard to really justify that, it's not about what we think the Fed should do in our forecast, it's what we think the Fed will do. And we think the Fed most likely will deliver the cuts that they have said over the next 2 meetings. In terms of the other 2 cuts, the ones in late 2026 or mid-late 2026, that really is an acceptance of what we think will be the political reality that Powell's successor will probably be considerably more dovish. And there are a lot of interesting things here. The first is that there's the question of what the Fed dynamics will look like. We saw, for example, Steve Myron was the sole dissenter, the newly appointed Fed governor and on leave chair of the CEA for Trump. He was the sole dissenter put down, presumably, his dot was almost certainly the far more dovish dot than any others in 2025. And so it leads us to think that most likely there's going to be a political shift in how the Fed is composed, and probably will be some deference given to by the committee to the new Fed chair, which allows us to feel that probably 2 more Fed cuts are likely than we had thought before, or than probably would have happened if Powell's term were to extend for, say, another year or 2.
Okay, yeah, that's fair enough. Put you on the spot a little bit, David. On the new Fed chair that you mentioned is a factor in terms of your latest forecast. When should we expect to hear about the appointment, and who do you see as the top contenders at this point?
Well, the first thing is there's a good chance this announcement of the new Fed chair is not coming in 2025. Historically, yes, it's true. It has come in the last few months of the previous year, so as early as right around now. But we should remember that typically the Fed chair's term has ended at the end of January, and this time, just because of when Powell was confirmed a few years ago, it ends in May. So there's a few extra months onto that, and therefore, I think the most likely thing is that it will not be based on the calendar year, but how many months are left in the term. So I would expect it to be later than maybe many others are expecting. Expect it to be a 2026 announcement. And I also think that's in keeping with how Trump has tended to operate. Trump likes to keep people guessing, keep his options open until pretty late in the game, and not corner himself into picking someone all that early. And so I think that a later announcement than is perhaps expected is consistent with that. In terms of course, who will be picked, our thought is that Waller probably hurt his chances by not dissenting yesterday. Waller may have been part of a deal. We were surprised that there were not more dissents than just Myron. We had expected Waller and Bowman to dissent on the dovish side as well, making for 3 dovish dissents. And that, of course, did not happen. And that may have been, as is very typical of how the Fed has traditionally operated, it may be indicative of some sort of a deal whereby Bowman and Waller agreed not to dissent in exchange, perhaps, for the dots moving down. And that really, that may actually have resulted in an October cut that might not have otherwise happened, or certainly a dot plot median moving in a way that it otherwise would not have. But at the same time, thinking just about what has tended to resonate with Trump in terms of who Trump picks for key posts, this probably is not the way to do it. This is a subtle argument, and Trump likes typically big, bold moves. This is not that. This is has the feeling of a bit of more of a backroom deal. And so ultimately, I think the likelihood is high that it's much more of a clear Trump insider / loyalist, someone like Kevin Hassett, the chairman of the NEC, perhaps Stephen Myron himself, who would be the next Fed chair.
Okay, got it. And then finally, any key data that you're watching for the following week for the U.S.?
Yeah, so we certainly have a much less exciting week than the last few have been. No top-tier data and no central bank decision. We do have some interesting things. We have new and existing home sales, both of which we expect to soften a bit more than consensus, in line with the weak housing starts and weak permits activity we saw this week. And of course, with general weakness we've seen in the U.S. housing market. We also see we'll see the advanced goods trade balance come out. We expect that trade deficit to narrow. Since Liberation Day, or even the lead up to Liberation Day, the advanced good trades balance has been very difficult to forecast accurately. There's been some big surprises in there. and that can affect, therefore, because net exports is a key component of GDP. That can actually have a big impact on a GDP tracking estimate based on how that comes out. So those, I think, are some of the more exciting things to look for in what is admittedly a less exciting week than the 3 we've just had.
Yeah, that's right. Yeah, still something to watch. But yeah, brilliant. Yeah, thanks very much, David.
Wonderful to be here.
Okay, let's swing over to London. Hey, Josie, thanks for coming back to the podcast.
Thanks for having me on, Euban.
Yeah, so I guess we just had the Bank of England decision. Any quick reactions to that, and where do we go from here?
Yeah, so the interesting part about this meeting was probably the decision on quantitative tightening that's only made once a year at this September meeting rather than the interest rate decision. So we were actually expecting another 100 billion of quantitative tightening this coming year, which would be consistent with what we've seen the previous few years. But they ultimately went for what's considered a middle ground option of 70 billion. And that's because that's a little less than halfway between the 49 billion that would be roll off only, i.e. no active bond sales, and the 100 billion, which I said would be a continuation of the previous rates. So that's actually pretty close to what there was kind of a consensus in the market, although views were very split actually. So when I say that, I mean it was close to the median, and there was a bank poll of market participants last month that suggested that was around 72 billion. So they went with kind of, I suppose, what was priced in by markets, and a key reason probably behind that decision, therefore, to go for 70 billion was so as not to make big moves in markets. As for the rate decision, there wasn't any surprises there. Policy rate was kept on hold at 4%, with 2 cents for a cut, and also guidance on policy remained identical, i.e. gradual and careful withdrawal of restraint. So, I mean, the Bank of England highlighted that future decisions on restrictiveness will, depend on things like disinflation, and that they don't have a preset path for rates. I think that means we're back to kind of watching what happens in the data. We think there'll be 2 more cuts, and we really are seeing what happens in particular on inflation to know where we're going forward from here.
Okay, yeah, got it. That's clear. And then in terms of the week ahead, we've got the Swiss National Bank and Riksbank next week. So what do you expect from both?
Thanks. Yeah, if I start in Sweden, as that's earlier in the week, we actually have 2 important events in Sweden. Before the Riksbank meeting on Tuesday, we actually have the government budget on Monday. And we already know that that's due to be quite expansionary. It's already been announced that this will include 80 billion krona of extra spending pledges and tax cuts, and that's equivalent to around 1.2% of GDP. That includes, for instance, a tax cut on food VAT. That will naturally bring down inflation next year, actually, but overall, as it's a more expansionary budget than the Riksbank would have expected, we think this will lead to faster GDP growth probably than they were previously expecting. So then when we come to the Riksbank decision on Tuesday, we're expecting a policy rate hold at 2%, but a rate cut is not completely out of the question. Some economists are probably expecting a cut. And that's because economic activity has been fairly weak recently, but we think there's enough evidence that it's picking up, that the Riksbank will be happy with that. And in terms of inflation, it's actually surprised quite significantly to the upside of the Riksbank's forecasts over the past few months. Now, that is expected to come back down in the future, but in terms of those recent prints we've seen, it's been quite high, so we don't think it will be able to cut this meeting. And then looking forward, we expect economic activity to pick up, especially with that expansionary budget. Now, turning to Switzerland, we've got the Swiss National Bank, SNB. We also expect it to keep the policy rate unchanged there, but it's at 0. So a cut would be taking the policy rate negative. And the SNB's president has been pretty clear that the bar is higher to the next rate cut because of the negative side effects associated with a potential negative policy rate. Now, obviously, they have had a negative policy rate in the past, so they're familiar with those side effects, and they would go there if needed. But key to our call that they won't cut the policy rate is that inflation has started to pick up. It's still very low, but there's evidence that it's picking up and will continue continue to do so. Therefore, it will be happy to leave its policy rate unchanged. A key thing to look out for is concerns about the impact of tariffs. Switzerland has a very high tariff rate on its exports to the US, 39%. That came as a big surprise in early August. So they might be concerned about economic activity looking ahead.
Okay, yeah, that's very, very clear for both. And then finally, anything else that you're watching in terms of the data for the calendar next week?
Yeah, I think another interesting set of data will be the PMIs that we get for Euro area and UK. In last month's report, we saw the pace of Euro area and actually UK activity picking up. And so we'll be looking out for that. But there were more concerns actually about price pressures building, again, but in both the Euro area and UK. So obviously we'll be looking for further hints of that.
Okay, that's great. Yeah, let's leave it there. Thanks, Josie.
Thanks a lot.
For Asia, wanted to mention some quick highlights. In the week ahead, the data calendar is relatively light, but we have Korea's first 20 days of exports for September, and we expect that to rise by 15.7% year on year, up from 7.6 in August despite the tariffs. That's mainly driven by strong chips exports. We also have a bunch of inflation data for Singapore, Malaysia, and Australia for the month of August, and we expect still relatively benign outturns. I also wanted to mention Indonesia, which is in the spotlight of late, given recent protests and the cabinet reshuffle, which saw the well-respected finance minister Sri Mulyani replaced. Despite these events, which have arguably contributed to some volatility in the currency, the central bank this week surprised with another 25 basis points cut, the third in a row. The tone was also more dovish, with Bank Indonesia emphasizing its policy is all out to support growth. BI also reiterated it will monitor room to lower rates, so its rate-cutting cycle is not yet done, despite also emphasizing weak policy transmission. Overall, we maintain our forecast that BI will cut its policy rate by another 50 basis points, but we see a risk that this all-out pro-growth stance could complicate BI's FX stability objective. I'm delighted to be joined by my next guest, Yusuke-san, who is actually based in London, but he is here in Singapore to visit clients. Yusuke-san, thanks very much for sitting down with me today.
Thanks for having me, Yuben.
What are your top conviction views that you've presented to clients this week?
Yeah, so we shared our view that the dollar yen is likely to trend lower from the recent rangy moving developments. Mm-hmm. Against the backdrop of that, there is somewhat still a likelihood of the BOJ's potential hike in October. So our base case is that the BOJ will deliver a hike in January 2026, but the BOJ will have its very important data, which is BOJ Tankan survey due on 1st of October. And if that data supports the view that the U.S. tariffs are not negatively affecting the Japanese economy, then the BOJ could become more encouraged to hike or reduce its monetary easiness in the October meeting. So that's one of the reasons we like the view that the dollar yen is likely to go lower. And also, the market seems to be pricing in a risk premium of new prime minister potentially becoming a dovish person. But we think that the new prime minister is unlikely, or it's more difficult to deliver a dovish policy given what's happening in the inflation development in Japan. So inflation in Japan has been above 2% for quite a while. So it will be difficult for the new prime minister to deliver a dovish policy. So overall speaking, we still like the idea that dollar yen is likely to trend lower.
Yeah, you mentioned it a little bit at the end of your response there. How important is the impact of politics on the yen? And can you give us any latest update on that?
Sure. So this LDP presidential election will be on 4th of October. And the biggest point is that there is a few candidates that are running for this election, and one candidate is pretty dovish in terms of her fiscal policy and monetary policy based on her past remarks. And as I mentioned earlier, the market seems to be pricing in that risk scenario that she could win the election. And as Nomura, we don't do predictions on elections, but based on our client survey results, her chance or likelihood of winning the election seems to be not high. In our survey, it was like 20% to 30%, whereas a more centrist candidate, he is more supported by investors in terms of the likelihood of winning, and that was 68 to 70%. So overall speaking, the market is prepared about possible risk scenario of a dovish new prime minister, but our opinion polls suggest that it's not likely the case.
Okay, yeah, that's really interesting. And then finally, you've met a few clients this week. What is the feedback which was most striking to you on all of those views?
Yeah, so the striking one was on the Bank of Japan. So there were a few investors kind of saying that the BOJ is already behind the curve, given that the core CPI inflation has been well above 2% for more than 3 years. But we mentioned that the inflation expectation in Japan is still below 2%, is still grinding gradually higher. So BOJ doesn't really have to rush to hike its policy rate. And if you see the market pricing and also economists poll rate hike in either October, December, or January, that's evenly split. So this makes the BOJ more decent flexibility in deciding in which meeting to hike. So the difference between like our view or my view between the investors I met was that, investors kind of seem to think that the BOJ should hike earlier, whereas my view is that it is a possible scenario, but BOJ doesn't really have to rush to hike. They have more flexibility in deciding which timing to hike.
Yeah, fantastic. Thanks again, Izuku-san.
Thank you very much, Eben.
That's it for now, and thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.